Hello, everyone, and welcome to the episode number 26 of JustDario Cigar Time. Last week, I took a break from dropping a new episode. Why? Because trade headlines kept popping up non-stop for the whole weekend. I wanted to wait for the dust to settle after the US and China trade representatives met in Switzerland, and boy, it was worth the wait. Let's clear the air. There was no trade deal last weekend, despite what some folks claimed. If anyone says otherwise, they might need a refresher on English comprehension. What we did get was a 90-day truce between the US and China. The US dialed back the extra tariffs slapped on China after April the 2nd. But here is the kicker. The original 30% tariffs, those will remain in place. There were also some tweaks to the tariffs rules. Goods imported from China valued at 800 or less will see no changes. But autos, steel, and agricultural products, also they will see no changes and getting hit with higher tariffs. Funny how the mainstream media conveniently skipped that part, right? So the clock's ticking. The US and China now have 90 days to hammer out a long-term deal. What are the odds they pull it off? Honestly, if the US accept that fixing the trade imbalances with China isn't a quick fix, I would say the chances are decent. My take, the current tariff setup will likely stick, but the US will crank up the pressure, not just on China, but on American and foreign companies to move the production back to the US for all goods that are sold in the country. Not long after the US-China truce was announced, President Trump dropped a bombshell on Truth Social, calling Europe a quote-unquote sneakier negotiator than China when it comes to trade. Ouch. That's a bold shot across the bow, especially since the tariff pause granted to everyone except China on April the 12th expires on July the 12th, about 2 months from now. So, what's the likelihood of the US striking a deal with the EU that both sides can stomach? Given Trump's comments, I'm not holding my breath. And it's not just Europe. Updates on trade talks with other partners, like India, Taiwan, or Japan, have gone eerily quiet lately. Anyone else notice that? The stock markets sure haven't. They are too busy riding the euphoria wave, chasing every bullish headline like it's a golden ticket. Take Japan, for example. During a recent parliamentary session, Japan's prime minister was crystal clear. No progress has been made with the US on trade negotiations. Japan is demanding the US scrap all tariffs imposed after April 2nd, including the baseline 10% commercial tariff. They want a clean slate, special treatment. Also both sides claim they were not even discussing currency manipulation on the yen's value. Really? Because today the news broke that exchange rates are part of the US-Japan talks, or quote-unquote conversations, as they're calling them now. And no one should be shocked. The Bank of Japan's been printing money like it's going out of style. In April alone, Japan's M2 money supply jumped by over 1 trillion yen. That's not pocket change. The yen has been sliding too, from 114 against the dollar in April to nearly 149 recently, before the BOJ stepped in to prop it up. Why? Because a weaker yen fuels inflation in Japan, and they are already grappling with sky-high prices. Fast forward 60 days, and the US faces a tough call. Extend the tariff pause for its allies or slap crippling tariffs on everyone but China. If the US stands firm and resumes tariffs, markets will tank hard. But if they blink and grant another extensions, trading partners might stop taking the US seriously. Why negotiate if you know the US will just kick the can down the road to avoid a bad reaction from stocks? Here is where it gets messy. Without trade deals, the US trade deficit stays bloated, piling on more debt. Servicing that debt gets pricier, and when you can't cover the tab, you have got two choices: print money or raise taxes. The latter, clearly, is not an option for Trump. As we know, printing money is inflationary. Now, tariffs themselves are inflationary too. Just look at Apple. They are already hinting at a 10 to 15% price hikes. And they're swearing it's got nothing to do with tariffs. Come on, we're not that gullible. Tariffs or not, companies pass costs to consumers, and that's a recipe for a higher inflation regime for years to come, especially if they have to deal with new tariff costs. The Federal Reserve knows it. Fed Chair Jerome Powell and other members are subtly shifting their tone, warning that rates might stay high longer than expected to combat future inflation shocks. But the Trump administration is not having it. They are publicly clashing with the Fed, pointing to, quote-unquote, conveniently rosy data from the Bureau of Labor Statistics, or, as it should be renamed, the Bureau of Lies and Storytelling. CPI and PPI numbers keep coming in just below expectations, triggering algorithmic buying sprees in the markets. Sound familiar? We saw this playbook during the Biden years. Release bullish data, watch markets soar, then quietly revise the numbers later when no one else is paying attention. Non-farm payrolls were a classic example, month after month of better than expected jobs numbers, only for revision to later wipe out 54% of the reported job gains. Same game, new administration. Speaking of smoke and mirrors, the Trump administration has been feeding the media a steady diet of bullish headlines. From Navarro to Lutnick to Benson, they are working overtime to keep traders hyped. And it's working, mostly because no one's digging into the substance. Take the recent Middle East trip. Every day we hear about massive deals, trillions of investment commitments from Arab countries to the US, memorandums of understandings, you name it. Qatar supposedly pledged 1.2 trillion to the US economy. Yes, trillion. Their GDP is 216 billion a year. You do the math. It's absurd, but the headlines keep the markets buzzing. Then there is NVIDIA, the golden child of the semiconductor world. They reportedly inked a deal to sell 18,000 high-end GPUs to Saudi Arabia and build a massive data center there, with plans to ship 1 million GPUs over time. Sounds amazing, right? Except it makes no sense. Data centers need cool climates to manage the insane heat GPUs generate. Building one in the desert? Good luck with that. And who's using all this AI computing power in the region? Crickets. Yet, the announcement sends semiconductor stocks soaring. Why? Because markets are drunk on optimism. But mark your calendars for June the 25th, when NVIDIA drops its Q1 2025 earnings. That's when the rubber meets the road. And I'll dive deeper into why this date could be the expiration point for the current market rally in the second part of this podcast I will release on Sunday. All right, folks, that's a wrap for today. We have covered the US-China tariff truce, Trump's jab at Europe, the global trade stalemate, and the inflation trap lurking around the corner. In the second part of this podcast, I'll dig into NVIDIA, semiconductors, and why June the 25th is the date to watch closely. Thanks for tuning in, liking, commenting, and subscribing to my channel, for your support on X, and to my blog, JustDario.com. Have an awesome weekend, and I'll catch you on Sunday for part 2.